Welcome to this revision series on accounting standard. I hope that this revision series will help you to quickly build your concepts and cover all the accounting standards in detail. If you like these accounting standards revision, do let me know by liking the video, by sharing this video with your friends and commenting your feedback, and also do not forget to subscribe our channel. So let us start on with the revision. Right guys, so let us start on with revision of accounting standard to valuation of inventory. In the first part, we'll cover up the concepts of the standard in a very quick fashion, and then we'll discuss some very important practical questions so that you know how to answer them and present them in the exams. So let's start with the revision. Accounting standard to valuation of inventories. In the most simple sense, inventory would mean the stock of goods in which the enterprise deals in. So based on the nature of the business of the enterprise, it could be a manufacturing organization, it could be a trading organization, it could also be a service oriented organization. So if it's a manufacturing organization, it would buy raw material and convert it into finished goods. So the inventory of a manufacturing organization would comprise of the stock of raw material, the work in progress, the finished goods, some packing material and stores and spares as well. But if we are talking about a trading organization would purchase goods and sell those goods in the same condition. So the inventory of a trading organization would be comprising of finished goods or traded goods. In case of a service oriented organization, based on the nature of service, it could either have no inventory or it could have some inventory of, let's say, consumables or some inventory of finished goods which it would sell during the course of rendering of these services. So let us have a look at the definition of inventory. Inventory has been defined by accounting standard 2 as inventories are asset held for sale in the ordinary course of business. So here we are referring to finished goods because finished goods are held for sale in the ordinary course of business. In the process of production for such sale, we are referring to work in progress. So it's in the intermediary state. It has moved on from the raw material state, but it has not reached till the finished goods state. This is basically the conversion process or the conversion state where the raw material is being converted or transformed into the finished goods in form of materials and supplies to be consumed in the production process. So here we are referring to raw material, packing material, and stores and spares which will be used in the production process. Now, we look at certain inclusions and certain exclusions from inventory. It says inventories includes material, maintenance, supplies, consumable, loose tool awaiting use in the production process. So these items will be used in the production process, whereas inventory do not include, so these do not form part of inventories, those spare parts, service equipment and standby equipment which meet the definition of accounting standard 10, which is PP. So basically this standard says that it is held for use. See, we saw that in the definition of inventory it says held for sale. Accounting standard 10 says it is held for use and it will be used for a period of more than 12 months. So if your spare part, service equipment or standby equipment is of a nature which meets the definition of AS10, means it is held for use in the business and it will be used for a period of more than 12 months, then it will not form part of inventory but it will qualify as PP as per accounting standard 10. Now we look at the measurement rule, right? It says that inventory should be valued at lower of cost and net realizable value. Basically this concept is on the basis of prudence or maybe we can say conservatism, right? It says that when you are valuing the inventory, you should look at the cost of the inventory, you should look at the net realizable value of the inventory, and whichever is lower, you should value your inventory on that basis. So let's say if the cost is 100 and the net realizable value is, let's say, 150, right? Net realizable value you can assume is a selling price. So if the cost is lower, then the net realizable value will value at cost because we will not recognize a profit, we will not inflate the value of our inventory. But let's say if the cost is 100 but the net realizable value of the inventory is 80, means we purchase it for 100 but now we are going to sell it for 80. So there is a probable loss which we could face, right, of rupees 20. So it says now value your inventory as 80 and recognize a loss which you would let's say incur in the future, right? So therefore the valuation norm, inventory should be measured at lower of cost and net realizable value based on the concept of conservatism. Now we look at the various components of cost. The cost would comprise of three components: the cost of purchase, the conversion cost and other costs. If we talk about cost of purchase, in case of a manufacturing organization, cost of purchase would have cost of purchasing raw materials, but in case of a traded organization, it would be cost of purchasing the finished goods which is going to sell. The conversion cost will basically come into picture only in case of manufacturing organization which buys raw material and then converts it into the finished goods. So let us look at each of these components. First of all, cost of purchase. So cost of purchase is very simple. We'll have the purchase price of the raw material, the finished goods, as the case may be, which is quantity into rate. If there is any trade discount or rebate, we will deduct from there. If there are any non-refundable duties and taxes, so look at GST. GST is the sales tax currently which is levied in India. GST is a refundable tax. You will not add GST here, but if there is a tax of a nature of which you do not get an input credit, you will have to add it here. Add directly attributable expenses. These directly attributable expenses are those expenses which are necessary to bring the goods from the supplier's premise to our premises. These are to be included in the purchase cost. So these are basically freight, carriage inward, transit insurance, etc. and we get our cost of purchase. Then we look at the conversion cost. Conversion cost is basically the cost incurred in converting the raw material into finished goods. So these are of two category: costs which are directly related to per unit of production and systematic allocation of indirect production overhead. Let us look at them. Let's take an example. We are into manufacturing of shirts. So basically the amount which we pay, let's say, to the labor for cutting the fabric, then stitching the fabric, ironing the fabric, right? That can be attributable to the per unit of production. For example, to cut a particular fabric for making a shirt, we pay them 30 rupees. To stitch that cut fabric and make it into a shirt, we pay 50 rupees. To iron a particular shirt, let's say, we pay 5 rupees. So these are directly related to per unit of production, means these are directly related to per shirt. Then we have certain expenses which are related to the production activity but which cannot be directly attributable to per unit of production. For example, let's say rent of the factory premises. Can we say how much rent are we paying per unit of shirt? No. Rent is paid on an overall basis. Similarly, electricity, similarly depreciation, similarly let's say salaries of various employees, maintenance staff, etc. which are there. These are expenses relating to the manufacturing but they cannot be directly attributed to a particular unit of production. Therefore, we have to allocate it to the cost of the finished goods, right, on some reasonable basis. Therefore, it's a systematic allocation of indirect production overheads. See, these indirect production overheads can be categorized into two categories: variable production overheads and fixed production overhead. What are fixed production overhead? These overheads are of a nature, the amount of which remains constant irrespective of the level of activity. Let's take an example. Let's say factory rent. If I manufacture 0 units, still I have to pay the same amount of rent to the landlord. If I manufacture 500 units, I have to pay the same amount of rent. If I manufacture 5,000 units, still I have to pay the same amount of rent. So these expenses are such which will remain constant, which will remain same irrespective of the level of production. Whereas variable overhead is something which directly varies with the units of production. For example, let's say the electricity charges. If the factory operates for 8 hours, the charge will be different. If the factory operates for 12 hours, the rate will be different. If the factory operates 24 hours, the amount of electricity bill will be different. So these vary with the volume of production. Now, while calculating the per unit rate, right, of fixed variable overhead, fixed production overhead and variable production overhead, what is the denominator that we need to take for calculating the rate? Because we know that the rate is calculated as amount by unit of production. So the allocation of fixed production overhead should be based on the normal production capacity of the production facility, whereas in case of variable production overhead, right, the rate should be calculated based on the actual production. Let us have a look with the help of an example. First, we'll talk about allocation rule for fixed production overhead, right? So it says when the actual production is approximately equal to the normal capacity. What is normal capacity? Normal capacity is the average production with the manufacturing facility has achieved over a period of time. That is treated as the normal capacity. So it says that the actual production which you have done during the year is approximately equal to your normal capacity. Then for the calculating the rate, you need to take normal capacity as the denominator. But if your actual production is less than your normal capacity, still you will not take the lower number, but you will take the normal capacity as the denominator for calculating the fixed overhead rate. But if your actual production is more than the normal capacity of the factory, then you need to use the actual actual production that you have achieved during the year for calculating the fixed overhead rate. Let us take an example. Let's say if your total production overhead is 20 lakh, fixed production overhead is 30% and variable production overhead is 70%. So 30% of 20 lakh, 6 lakh is fixed production overhead and 14 lakh is basically a variable production overhead. Your normal production capacity is 10,000 units. So over a long period of time, on an average during a year, you produce 10,000 units. Now there are three cases which we have taken up, right? Please follow this example very carefully. First, if your actual production is 9,980 units, so it's basically approximately equal to your normal capacity. Whereas in the second case, your actual production is 8,000 units, so your actual production is less than your normal capacity, right? And basically in case of your actual production is 12,000, then you would say that your actual production is more than your normal production capacity. So in case it's approximately equal, and in case if it is less, you take normal capacity as your denominator, and in case actual production is more than your normal capacity, then you take the actual production as your denominator. So let us calculate the rate. So fixed production overhead, we have calculated 6 lakh as fixed production overhead, divided by 10 lakh, which is my normal capacity, we have 60 per unit. In the second case also 6 lakhs is the fixed production overhead. We'll take the normal capacity as the denominator, 60 is per unit rate. But in the third case, 6 lakh is the fixed production overhead and 12,000 is the actual production, which is more than my normal capacity. In this case, our fixed production overhead rate is 50. Basically, the logic is that if there is inefficiency, you do not reduce the denominator and increase the per unit rate. But if there is efficiency, you are operating at more than your normal capacity, you should get the benefit, right? And your cost of production should be less. Then in case of variable overheads, if the rate is the method of calculating the rate is very simple. You need to take the actual production. So 14 lakh is your overhead, 9980 in the first case, 8,000 in the second case, and 12,000 in the third case. So what you need to remember, variable overheads, it is to be calculated on the basis of actual production. In case of fixed production overhead, if it approximates or if it is less, you take normal capacity, but the actual production is more than your normal capacity, then you will take your actual production overhead to enjoy the benefits of the efficiency. Now we'll talk about joint product and byproduct. See, this is a scenario where in a particular production process, right, there are two or more than two outputs which you achieve. For example, let's say we grind wheat to let's say convert it into atta or flour. So if we put the wheat into the grinding machine, there are two types of powders which will come out. One which will be atta and other powder will be maida, which will automatically come out in the production process. Now these can either be treated as joint product or these can be treated as byproduct. So what is important, that there is a single production process, you put in certain inputs and you get two or more than two outputs in that production process. Then these two or more than two outputs can either be treated as joint products or they are to be treated as byproduct. When do you call them as joint products? When the value of these two or more than two products is more or less similar, right? Then you call them as joint product. But in the production process, let's say you get two products, the value of one product is very, very insignificant as compared to the value of the other product. Then in that case, the product which is insignificant will be treated as byproduct and the product with significant value will be treated as the main product. Now the problem is that there is one input, but there are two or more than two output. So how do we allocate this cost of one input over the production of two or more than two output? That is what we are going to learn here. So joint product and byproduct production process may result in more than one product being produced simultaneously. These products can either be treated as joint product or there could be a scenario of a main product and a byproduct. Both products are of more or less similar value, right? When both the products are more or less significant or similar value, we will say that these products are joint products. But if, let's say, the byproduct, they are immaterial as compared to the main product. So the product which is immaterial will be treated as byproduct and the other product which has a significant value will be treated as main product. Now let's talk about the valuation rule. In case of joint product, allocation based on relative sales value of each product. But in case of byproduct, you will value the byproduct as its net realizable value, means you will assume the cost of the byproduct to be its net realizable value, because that value in itself is very insignificant. And what will you do? From the total cost incurred in the production process, you will reduce the NRV of the byproduct, you will get the cost of the main product. Let us have a look at it with the help of an example. First, we'll take an example of a joint product. Let's say our total production overhead is 20 lakhs. By incurring this production overhead, we get two product, joint product A and joint product B. The production of A is 10,000 units and production of B is 12,000 units. The selling price per unit of A is 500 and the selling price per unit of B is 460. So here we have sales value of product A as 50 lakh and sales value of product B as 55 lakh 20,000. So comparatively they are more or less significant or similar value. So how do you allocate this 20 lakh of joint cost which has been incurred in producing these two products over product A and product B? You need to do it on the basis of ratio of the relative sales value. So basically you need to apportion this 20 lakh in the ratio of 50 lakh is to 55.20 lakh. So cost of joint product A is 20 lakh, which is the production overhead, divided by 50 lakh plus 55.2 lakh into 50 lakh, we'll get the joint product cost of joint product A. Similarly for B, 20 lakh divided by 50 plus 55.2 into 55.2, we'll get the cost of joint product B. So this is how the allocation of the cost has to be done. It has to be done in the ratio of the sales value of the joint product. Now we'll talk about byproduct. That's a similar. We have a total production overhead of 20 lakh. Here we have a production of steel, which is the main product, and in the production process certain oils have been generated, which is the byproduct, right? We have produced 500 liters of oil and the NRV per liter is 20. So the value of byproduct will become 20 liters into 20 per liter, 10,000. How we'll calculate the cost of the main product, which is steel? Total production overhead is 20 lakh, whereas the NRV of byproduct is only 10,000. The cost of the main product will be calculated as 20 lakh minus 10,000, which is 19 lakh 90,000. Now we'll move on to the next category. We covered the cost of purchase, we covered the conversion cost. Now we'll talk about other costs. These other costs are basically those costs which are incurred in bringing the inventory to its present location and condition. For example, we got an order from a customer and we need to design the product first and then manufacture that product. The cost which we incurred in designing that product will also form part of the cost of the inventory. Now we'll talk about certain exclusion. Interest and borrowing cost will not be considered as part of inventory unless our inventory is a qualifying asset as per accounting standard 16. That means the inventory takes a substantial period of time to get ready for its intended sale. Exchange difference fluctuation will never be included in the cost of the inventory. You need to remember these specific exclusion. These are very important, right? These type of costs will never be included in the cost of inventory. Abnormal wastages of material, labor and other production overhead. Please remember, abnormal wastage is never part of your cost of inventory, but normal wastage is part of the cost of your inventory. We'll have a look at it with the help of a practical example. Storage cost will never form part of the cost of inventory unless storage is incidental. For example, let's say when you are brewing a wine, right? So you need to store it at certain stages, right? In that case, maybe the storage cost will become part of the inventory, but generally storage cost will not be part of your inventory. Administrative overhead, which do not have anything to do with bringing the inventory to its present location and condition, will not be considered, and selling and distribution cost will not never be considered as part of inventory. Now we'll talk about cost formula, right? While you're doing the valuation, right? For calculating the cost of the inventory, in certain circumstances, we need to use certain cost formulas. Now, which cost formula to use will depend upon the nature of the inventory. If we talk about the nature of the inventory, inventory can be categorized into two categories. One which is not ordinarily interchangeable, other which is ordinarily interchangeable. Let us have a look at an example. For not ordinarily interchangeable, it says that the nature of the inventory is such that if you mix the item of inventory with other similar items, each item will not lose its identity. You will be able to identify specific cost of each item of the inventory. Let's take an example. Let's say we deal in mobile phones. We purchase 500 Samsung A7 mobile phones, right? These mobile phones are purchased at different prices and these are stacked in our warehouse. So now since these are purchased in various prices, we need to identify the cost of each mobile phone. Can we do that? Answer is yes, right? Because each mobile phone will have a separate and a different IME number, and with the help of this IME number, we'll be able to assign the cost to these particular phone. But if we talk about ordinarily interchangeable, these are such inventories which is mixed with other similar item, the inventory will lose its identity, will not be able to assign specific cost of this identity. Right, inventory. We'll take an example. Let's say we are into selling of sugar. There's this drum. We purchase certain quantity of sugar at 50 per kg and we put it in the drum. Then we purchase at 51 per kg, we put it into this drum. Then we purchase at 52 per kg and we put it into the drum. And then we keep on selling the sugar from this drum. At the end, some quantity of sugar is left. Will we be able to tell how much of quantity is of 51, how much is of 50 and how much is of 52? The answer is no, because once they are mixed, we are not able to identify the specific cost. So in this case, we need to use certain cost formula to calculate the cost of the inventory. So let us have a look. If it is not ordinarily interchangeable, there is no problem in identifying the cost of specific inventory. So the cost formula to be used is basically specific identification of cost method, because we know specifically what is the cost of each item. But if it is ordinarily interchangeable, let's say we purchase, let's say 100 kg, 200 kg, 300 kg. Total 600 kg we purchase, 400 kg sold, 200 kg is my closing stock. Can I tell that this 200 kg how much is of 50, 51 and 52? Answer is no. So here we need to use certain cost formula to calculate the cost of the inventory. So here the accounting standard 2 says that either you can use the weighted average method or you can use the FIFO method for calculating the cost of such inventory. It also says that other techniques like standard cost and retail method may be used for convenience, but these have to be used only when the answer calculated, that the value calculated by using this method is approximately equal to the actual cost of the inventory. Then we'll talk about net realizable value. We're done with the cost excel. Now net realizable value would generally mean the estimated selling price of that inventory less certain expenses which are necessarily incurred in selling those inventory. So we know generally inventory can be categorized into 3 categories, which is raw material, work in progress and finished goods. So we'll understand how do we calculate the net realizable value of each of these category of inventory. So net realizable computation based on type of inventory. So if we talk about finished goods, net realizable value is estimated selling price minus cost necessary to make the sale. Matlab these are those expenses which are necessary to be incurred if you want to make a sale. For example, we have a CNF agent, we have a commission agent. All our inventories are sold through this commission agent. So whenever we make a sale, we need to pay a commission to this person. Maybe we have a contract with customers that it is our responsibility to deliver the goods to the customer. So if we are making the sale, we will have to incur the transportation cost. So these type of expenses which are necessary while you are making the sale will be reduced from the estimated selling price to arrive at the net realizable value. Then in case of work in progress, we calculate the NRV. The first question which comes in our mind is, okay, sir, we do not sell our work in progress, then why do we need to calculate the NRV and do a comparison with cost and NRV? See, although we don't sell our work in progress, but still what happens is that this work in progress will be converted into the finished goods, and if the total cost of finished goods is greater than the net realizable value, there's a foreseeable loss which we are sitting on. That is why we need to calculate NRV of work in progress as well. So how do we calculate? We'll have the estimated selling price, from which we will reduce the estimated cost of completing that inventory, because still it is an unfinished form, less cost necessary to make the sale. This will be the NRV. We will compare it with the cost, whichever will be lower will be the value of work in progress. Now we'll talk about net realizable value of materials and supply. So basically we are talking about raw material. Again the same question, that raw material will be used in making finished goods. We are not going to sell the raw material as such in the market. Why do we need to calculate the NRV? The answer remain the same, because you will convert the raw material into finished goods and that finished goods will be sold in the market. If after converting, right, the cost and the NRV of the finished goods is lower, then there's a probable loss which you will incur. So there might be a scenario that you might not even make the finished goods, you might sell the raw material as such to minimize your losses. Right? So for various reasons it is important to calculate the NRV of raw material as well. Now how do we calculate this? Right, what we need to do, we need to first check that of the raw material, the finished goods that we will make, right, at what value these finished goods will be sold. If these finished goods will be sold in profit, then we are not supposed to do anything else. The raw material will be valued at cost, because we know that the raw material will be converted into finished goods and the finished goods will be sold at profit. But if when we make the finished goods will be sold at a loss, means the cost of production of the finished goods will be greater as compared to the net realizable value of the finished goods, and also there's a decline in the market price of the material, the raw material prices are declining, then in that case we need to write down the raw material to its NRV. And what is the NRV of raw material? The replacement cost of the raw material, means at what value is raw material available when we are doing the valuation of these raw material will be treated as the replacement cost. We'll do it with the help of a practical example as well in a bit. Comparison of cost and NRV should be done on an item by item basis. For example, we have item A, we have item B, and we have item C. The cost of item A is 100, this is 150, and this is, let's say, 200. This total works out to 450. Then here the NRV is 80, the NRV is, let's say, 180, and the NRV is, let's say, 260. Here the total comes out to, let's say this is 1422 to 520. You will not calculate on the basis of 450 and 520, right? You will do it on the basis of item by item basis. Here it will be 80, here it will be 150, and here it will be 200. So this basically works out to 430, which will be your value of inventory. So you need to compare each item individually while calculating the value of inventory. Then NRV of goods held for specific purpose. This is very interesting. Normally what we do is that we do a comparison of cost and net realizable value. But if there is certain inventory which is there in our stock, of which we have a firm sale contract, means we have already entered into a non-cancelable contract, in that case so much of the portion of inventory, the NRV will be the contract price at which we have contracted to sell those inventory in the subsequent financial year. Let's take an example. NRV of goods held for specific purpose, NRV of quantity of inventory held for firm sale or service contract. What is firm sale or service contract? It's a definite contract which is a non-cancelable contract which will be executed in future. Is based on the contract price. Let us have a look at the example. Let's say quantity of closing stock at the year end is 5,000 units. Units under firm sale contract is 1,500. So out of 5,000 units, we have already made a contract for selling these 1,500 units in future, and remaining 3,500 units are not covered by any firm sale contract. The cost per unit is 200, the NRV is 180. We can see that the NRV is lower, but the contract price of firm sale contract is 240, means these 1,500 units we have contracted to sell, and it's non-cancelable contract at 240. So valuation of stock under firm sale contract, we'll be calculating it at lower of cost, or the contract price, cost is 200, contract price is 240, so 1,500 into 200. For remaining stock, we will compare 200 and 180, so 180 is lower, so 3,500 into 180, 6,30,000 is the inventory. Total value will be basically 3,000 plus 6,30,000 will be the total value of my inventory. Now we'll talk about the disclosure requirement. We need to talk about the accounting policy followed for valuation of inventory, which would basically be the cost or NRV, whichever is lower. We'll say what is the cost formula that we have adopted, whether we have done on specific identification of cost basis, whether we have done it on the basis of let's say FIFO, whether we have done it on the basis of weighted average, and we'll talk about total carrying amount of the inventory, means total value of the inventory. Total carrying amount would mean total value of the inventory, and classification of inventory into raw material, work in progress, as the case may be. So by this we are done with the revision of the content portion. Now we'll start on with the practical exercise. Now we look at two examples, one on calculating the NRV of raw material, other on calculating of normal loss, and then we'll move on to the practical exercise. So let's start on with the example. Example on NRV of raw material. Follow this very closely. Let's say the cost of the raw material is 800. The current replacement cost of this raw material is 750. So there is a decline in price of the raw material. We purchased it for 800 and now it is selling in the market for 750. The estimated selling price of the finished goods in the first case is 1250 and in the second case it is 1000. So we have taken two scenario, case A and case B. The estimated conversion cost means the cost incurred in converting the raw material into the finished goods is 300. We need to calculate the NRV of raw material. We need to calculate how the raw material will be valued, whether it will be valued at cost or whether it will be valued at NRV, which is the replacement cost. So first we look at the solution. So it says total cost of the finished goods. See, the cost of the raw material is 800 and conversion cost is 300. So the total cost of producing the finished goods is 1100. In the first case, the NRV is 1250, which is more than the cost. So we have said that while we are calculating the NRV of raw material, if the finished goods is to be sold at a profit, we don't need to do any adjustment and the raw material is to be valued at its cost. But in the second case, the cost of the finished goods is 1100 and the NRV is 1000. So here there is a probable loss, right? Once we convert the raw material into finished goods and we sell it in the market, there is a probable loss we'll incur. So in this case, we need to value the inventory at its NRV, which is its replacement cost, which is 750. So let us look at both the cases. Case A, we say that the selling price is 1250, whereas the cost is 1100. There's a profit of 150 that we will be earning. Since finished goods will be sold at a profit, no adjustment is required. Raw material will be valued at cost of rupees 800. In the second case, the selling price is 1000 and the cost is 1100. So there's a foreseeable loss which we may incur of 100. Since finished goods will be sold at a loss, raw material is valued at its NRV, which is its replacement cost, which is to be valued at 750. Now we'll move on to the second example, which is an example on normal loss. See, we had seen that in case of specific exclusions, we have discussed that the cost of the inventory will not include abnormal wasted material, labor and overhead. So we need to exclude the abnormal wastages and charge it off to the PL. It should not form part of the cost of the inventory. But in case there is a normal loss is something which is unavoidable, right? Which will be incurred, right, without any fault, right? It is basically because of the inherent nature of the goods is such that these losses will be incurred. For example, if you are transporting some liquid or petrol, etc., from one place to another, right? If there will be some evaporation, there will be some leakages, etc., because that is inherent to the nature of that particular item of inventory. So let's have a look. In the production process, normal wastage of input is 5%. So 5% to the extent of 5% we'll consider as normal, and normally this is unavoidable nature. 5,000 metric ton of input were put in the process, resulting into a wastage of 300 metric ton. So on the basis of normal wastage, if we say 5,000 metric ton into 5%, the normal wastage would have been 250 metric ton, but the actual wastage is basically 300 metric ton. So we have abnormal wastage of 50 metric ton, which is the difference between 300 and 250. Cost per metric ton is rupees 100. The entire quantity of waste is on stock at the year end, so we need to value the inventory and the value of abnormal loss. So we say that the total wastage is 300 metric ton less normal wastage, which is 5,000 into 5% of normal percentage, which is 250, and our abnormal wastage works out to 50 metric ton. Now let us have a look at the value. See, we'll have a closing stock of 4,700 metric ton. How? 5,000 unit was in input, 300 unit is loss, and then 4,700 unit is in closing stock. How we will do the valuation? Let us have a look. The value of inventory will be cost divided by total quantity minus normal loss quantity into the closing stock quantity. So 5,000 is the quantity which was purchased at 100 per metric ton, divided by 5,000 into 5,000 minus 250, which is my normal loss quantity, right, into the quantity of closing stock. We'll get the value of the closing stock. Value of inventory, this will basically be the value of abnormal loss. Total cost divided by total quantity minus normal cost quantity into abnormal loss quantity, which is 50. So 5,000 into 100 divided by 5,000 minus 250, which is my normal loss quantity, into 50, which is my abnormal loss quantity, right, and we'll get the value of abnormal loss, right? So this is how we'll make a calculation when we need to calculate the value of inventory and the abnormal loss in case there is a normal and an abnormal loss which is simultaneously there, right? Always remember that while you are calculating the per unit rate of inventory from the total quantity, you will always have to reduce the normal loss quantity. Then we'll move on to the practical exercise. Let us start on with practical exercise. Sum number 1. Sum number 1 is absolutely similar to the example on normal loss which we have done. So we'll quickly go through it. It says Capital Cables Limited has a normal wastage percentage of 4% in the production process. During the year 13-14, the company used 12,000 metric tons of raw material costing 150 per metric ton. At the end of the year, 630 metric ton of wastage was in stock. The accountant wants to know how this wastage is to be treated in the books of account. Explain in context of AS2 the treatment of abnormal loss, and basically it will be normal loss, and also find out the amount of abnormal loss if any. So in any AS based question, we already know that it has to be divided into three paragraphs. First paragraph we'll have to state the requirement of the particular standard. Second paragraph will be our analysis of the case which has been provided to us, and the third paragraph there should be a conclusion as to what is the treatment according to the standard and based on the facts of the case. So we'll say, as per accounting standard 2, valuation of inventory, abnormal amount of wastage material, labor, production overhead excluded from the cost of the inventories, and such cost is recognized as an expense in the period in which they are incurred. Normal losses will be included in determining the value of the inventory. So let's have a look at the computation. We have been told that the total wastage is 630 metric ton, whereas the normal wastage is 4%. So 12,000 of input into 4%, which becomes 480. So 150 metric ton is our abnormal wastage. So we'll calculate the abnormal wastage, total quantity into rate per unit divided by total quantity minus the normal loss quantity into the abnormal loss quantity. We'll get the value of abnormal loss. Value of closing stock, again same, total quantity into the per unit rate. This is my total quantity minus the normal loss quantity into this is my closing stock. We'll get the value of closing stock as well, right? We'll move on to the second question. It says the closing stock, the closing inventory at cost of company amounted to 2,84,700. So this is our total inventory cost at the year end. The following items were included in the cost in the total. So these items are included in this 284,700. 400 coats which had a cost of rupees 80 each, and normally they were being sold at 150 each. Owing to some defect in manufacturing, they were all sold after the balance sheet date at 50% of the normal selling price. So 50% of the normal selling price would mean rupees 75, because normal selling price is 150 and the cost per unit is 80. So we can call this as the NRV, because after the year end this has been sold at 75. Selling expenses amounted to 5% of the proceeds of 75 into 5% will be the selling expenses per unit. So how do we deal with it? It's very evident that the cost is 80 whereas the NRV is 75 minus 5% of expenses. So we'll say cost or NRV, whichever is lower, and it will be valued as its NRV. 800 skirts which had a cost of 20 each, right? These two were found defective. Remedial work in April cost 5 per skirt, and selling expenses for the batch totaled 800. They were sold at rupees 28. So the NRV of this item is basically 28, but there are certain expenses which are incurred. So here we need to see the total value of inventory according to AS. To in this case, again we will say that inventories which are damaged or which are partially or obsolete, right, and there is a decline in the selling price, we need to make an adjustment. The estimate of net realizable value are based on most reliable evidences which are available at the balance sheet date, though the subsequent selling price is the most reliable evidence of the NRV. Fluctuation in price or cost directly relating to the event occurring after the balance sheet date, to the extent such event confirm the condition existing at the balance sheet date, needs to be worked upon, because the inventory was defective, etc. So subsequently when it is sold, it provides a further evidence. Now let us have a look at the computation. Computation based on accounting standard 2, right? The total cost of the inventory is 2,84,700, which includes the cost of the above coat and skirts. So we'll say total cost is so much, decline in value of 400 coats. See, the cost of the coats is 400 into 80, whereas the NRV is 400 into 150 ka 50%, which is 75, and minus this is the selling expenses of 5% of 75, so this works out to 28,500. So this will be the value of the inventory. Currently it is included at 32,000, but we need to bring it down to 28,500, so we need to reduce 3,500 from this to bring it down. But in case of skirts, right, see the cost of the 800 skirt is 800 skirts into 20 per unit, 16,000. If we talk about the NRV, the estimated selling price is 28, so 800 into 28 is the estimated selling price. There are certain costs which are necessary to make the sale. First, we need to make certain repair work to the skirts, and we need to incur certain selling expenses. So cost of repairs is 5 per unit and the selling expenses is 800. So the NRV works out to 17,600. Cost is 16,000, whereas NRV is 17,600. So it should be valued at cost, and it is included in the cost, so we don't need to make any adjustment, right? Since the net realizable value is greater than cost, no adjustment is required in case of skirts. So whatever adjustment was required in case of coat, we did the adjustment because it was included at cost. We need to include it at NRV, so we reduce the difference between cost and NRV to arrive at the NRV. Let's move at the next question. The raw material inventory of a company includes certain material which is purchased at rupees 100 per kg. The price of material is on a decline and the replacement cost of inventory is 75 per kg. So we purchase it at 100, but currently the replacement cost, if we buy the same raw material right now, it will cost us 75. It is possible to convert the material into finished goods by incurring a conversion cost of 125. So basically the cost of raw material is 100, the conversion cost is 125. So 225 will be the total cost of my finished goods. Decide whether to make the product or not to make the product if the selling price is 175 in case 1 and 225 in case 2. See, it's very clear. The total cost of finished goods will be 225. And if it will be sold at 175, there is no point in making this. Why? Because by making this, we will incur a loss of 50 rupees, which is the difference between 225 and 175. But if we don't make it and we sell the raw material as such in the market, right? We purchase it for 100, we can sell it off at 75. Na? So there will be a loss of 25. So what is better? To incur a loss of 50 after making the finished goods, or to sell the raw material as such in the market, right? And incur a loss of 25. Obviously we'll have to minimize our losses, so we'll not make the product. In the second case, it says that you can sell it at 225. So in this case, there will be no loss because our cost of production will be 225 and we'll be selling it at 225, so there will be no loss. But if we sell the raw material as such, we will incur a loss of 25 because we have purchased it at 100 and we'll be able to sell it at 75. So in the second case, it is better to make the product and incur no profit, no loss. So let us have a look at it. It says, as per AS2, materials and other supplies held for use in production of inventory are not written down below cost if the finished product in which they will be incorporated is expected to be sold at or above cost. So if you are able to sell your finished goods at profit or maybe at cost, then you don't need to make any adjustment to the value of raw material. But if the finished goods is going to sell at a loss, then you need to value your raw material at NRV, which is the replacement cost. However, where there is a decline in the price of material and it is estimated that the cost of the finished product will exceed the net realizable value, material are written down to its net realizable value and the replacement cost of the material is considered as the best measure of the net realizable value. So here the cost of raw material is 100, the conversion cost is 125, the total cost will work out to 225. In the first case, if the estimated selling price is 175, there will be a loss of 50. Right, by making the product. In such case, the product should not be made and the raw material should be valued at 75, which is the replacement cost. In the second case, the estimated selling price is 225. There will be no profit or loss. The product should be made. The raw material should be valued at 100 because there is no foreseeable loss which the enterprise will incur. Then, question number 4, Mr. Mehul gives the following information relating to items forming part of inventory on 31st March 15. His factory produces product X using raw material A. So this finished goods is basically product X and his raw material is basically A. 600 units of raw material A purchased at 120, the replacement cost of raw material A at the year end is 90. So here there is a decline in the cost of the raw material. We purchased the raw material at 120, but the replacement cost of the raw material is 90. So we need to look at how we need to value it. It cannot be only based on 120 and 90. We need to see that the finished goods, whether it will be sold at a profit or loss. If the finished goods can be sold at a profit, we will value it at 120. If the finished goods can be sold, it will be sold at a loss, then we will value this raw material at 90. 500 units of partly finished goods, which is the work in progress, in the process of producing X, and the cost incurred till date is 260. So this is the cost of my work in progress. These units can be completed in the next year by incurring an additional cost of 60. So this is basically cost necessary to complete. Since it is unfinished, further 60 will be incurred to complete the product. 1500 units of finished goods X is there in the stock. Total cost incurred in producing it is 320 and the expected selling price is 300. So obviously this finished goods need to be valued at 300 because we will compare cost and net realizable value. Cost is 320, net realizable value is 300. So obviously it should be valued at 300. Right? Determine how each of the item of inventory will be valued and also calculate the total value of inventory as on 31st March 15. So basically what we need to see is, first, when you're doing the calculation for raw material, the cost of our raw material is 120, right? And once we try to complete this raw material, see what will be the total conversion cost. 260 is something which is already incurred and 60 will be incurred in future. So 260 plus 60 is total conversion cost. So how much will it cost? It will be basically 440 will be the cost of finished goods, whereas the selling price of the finished goods is only 300, which is the NRV. So obviously here there will be a loss. We need to value raw material at 90. If we talk about the work in progress, the selling price, right, the NRV is, or the estimated selling price is told to us is 300, and we will incur additional expenses to complete of 60. So basically 240 becomes the NRV of WIP, whereas the cost which we have incurred till date is 260. So here the NRV is lower, so it again has to be valued at its NRV. And then finished goods we have already talked about. So here first in the paragraph we will talk about the valuation norm of how the NRV will be calculated for basically the finished goods, the raw material and the work in progress. Now we'll do the analysis of the case. 600 unit of raw material will be written down to its replacement cost of 90 per unit as the net realizable value of finished product in which the raw material will be incorporated is below its cost. Then for 500 units of partly finished goods, we know the estimated selling price is 300, estimated cost to complete is 60. We don't have detail of selling expenses, otherwise the selling expenses would have been deducted. So NRV is 240, whereas the cost is 260, so it has to be valued at its net realizable value, which is 240. Then for 1500 units of finished product, obviously 300 is lower than 320, of course it has to be valued at 300. So raw material 600 unit at 90, which is the NRV. Partly finished goods 500 unit is 240, which is the NRV. 1500 units of finished goods at 300, which is the NRV, which this will be the total cost of my inventory. Let's move on to question number 5. A Limited is engaged in manufacturing chemical Y from raw material X. So this is my finished goods, this is my raw material, right? The company provides you with the following information for the year ended 31st March 17. Raw material X, the cost price is so much, unloading charges, freight is so much, so this will be considered as directly attributable expenses, and the total cost here would be calculated as 380 plus 20 plus 40, whereas the replacement cost is only 300, so there is a decline in the price of the raw material. Chemical Y, material consumed is 440, which is the total cost of the material. Direct labor is 120, variable expenses is 80, so these are the conversion costs. Additional information says the total fixed overhead for the year is 4 lakh and the normal capacity is 20. So we know that we calculate the fixed overhead based on the normal capacity. They haven't given us the information of actual production during the year. So 4 lakh divided by 20,000, right? This will give us basically 20 per unit. So here our fixed overhead rate becomes 20 per unit. So total cost of finished goods is basically 740 works out to be the total cost of the finished goods, right? Then we'll say, we'll see that the closing balance of raw material X is 1000 units, finished goods is 2400 units. You are required to calculate the total value of closing stock of raw material and the finished goods according to AS2 when the net realizable value of chemical Y, which is the finished goods, is 800 and is 600. So see, in the first case, I am seeing that the total cost of production is 740 and the net realizable value is 800. So the finished goods will be sold at a profit. So in case of raw material also, raw material will be valued at cost and the finished goods will also be valued at cost. But in the second case, the total cost of production of the finished goods is 740, but the NRV is 600. So in this case, the raw material will be valued at its replacement cost and the finished goods will be valued at its NRV, which is rupees 600. So let us look at the drafting. So here again you read this text, it basically talks about what is NRV and how the NRV is calculated, etc. Let us come to the computation. Calculation of cost per unit. 380 is the purchase price, 20 is the unloading, 40 is the freight, 440 is the total cost of my raw material. Then cost of finished goods, material consumed is 440, direct labor 120, variable overheads is 80 and fixed overhead is 20. So this works out to 660. I think I made a mistake while adding it here. It should not be 740. It should be 660. This is basically, this works out to 0, 8 plus 2, 10, 12, 16, 16, 1. This is 660. So still in the second case, the NRV is 600 and this is 660. So the things remain the same. So 660. So in the first case, if the net realizable value is 800, the finished goods is selling at profit. So in this case, NRV of chemical Y is 800, which is greater than the cost of 660. Hence, both raw material and finished goods should be valued at cost. In the second case, so this is the total value, 1000 into 440, which is the cost, and 2400 units into 660, which is the cost. This is the total value of the inventory. In this case, the NRV is 600, whereas the cost per unit is 660. Therefore, raw material should be valued at replacement cost and finished goods should be valued at net realizable value. So replacement cost of raw material has been given as 300 and the NRV of finished goods is given as 600. This should be treated as the value of inventory, right? So by this, we are done with the practical exercise of accounting standard 2 as well. Please go through each and every practical question in detail, right? I have tried to cover the major variety and hopefully that this will help you greatly in doing your preparation. Also, please do not forget to share this video with all your friends and subscribe our channel, like and comment videos. You can also contact me anytime if you need any help from me. Thank you so much and all the best.